Welcome to the Data Enriched Bushels podcast. I'm your host, Christopher Rule, and joining me today are Dan Olson and Brad Justice. Dan, with over 40 years in the ag industry, is the founder of JAG Group, and Brad is a climate entrepreneur and former CEO of Soil Metrics. Today, we'll be talking about Gevo's acquisition of Red Trail Energy. Gevo's acquisition of Red Trail in September is a significant development for the ethanol industry. Gevo, a leader in sustainable fuels, purchased Red Trail Energy's ethanol production facility and carbon capture and sequestration, CCS, assets for $210 million. This move positions Gevo to expand its sustainable aviation fuel production by utilizing Red Trail's existing low-carbon ethanol capabilities and leveraging its on-site CCS, which is projected to sequester 180,000 metric tons of CO2 annually. This acquisition is crucial for the ethanol sector because it highlights the growing integration of carbon capture technology with biofuels production. By reducing the carbon intensity of ethanol, it becomes a more viable feedstock for SAF, helping the industry meet stricter carbon reduction targets. For Gevo, it strengthens their position ahead of their broader Net Zero 1 project. While for the ethanol industry, it showcases how existing facilities can be transformed to support the transition to low-carbon fuel technologies. Today's topics include strategic implications of the acquisition, carbon reduction and sustainability strategies, the impact on local agriculture, policy and the regulatory environment, and the future of biofuels. Before we begin, could you gentlemen please introduce yourselves? And Dan, as I understand it, you have a unique perspective on Red Trail. Could you highlight that in your introduction?
Yeah, sure, I can try. We're in North Dakota. It's rather interesting. It's a interesting space because everybody knows everybody in North Dakota, and the streets are really long. So, yeah, we've been very involved with Red Trail over the years, and they've been active with the board of directors and others, and from an investment perspective, and so it's been it's been an interesting time. I've been involved with actually both plants in North Dakota that have had carbon sequestration wells drilled into them. So coming from a board perspective and different things and investment perspective, it's been an interesting time to kind of take a look at why those decisions were made early on and where they're at today. So,
Brad?
Chris, a little introduction. I'm Brad Justice. I think you gave a little bit of an overview. My point of view in this place is around the carbon capture, some of the modeling, that piece of it, the business economics of that, and with regard to the Gevo acquisition of Red Trail, I think my point of view, very at the top here, is they've been looking to buy something for a while, and they found a solution, right? And they needed to do something. I think there was some urgency for them to deploy cash, deploy dollars, especially in context of the IRA. And I think they put their bet there at the Red Trail site. The other thing to remember about Gevo is for a long time they were going to the DOE the Department of Energy's loan office, asking for, I think it was $950 million. So no small sum of money. So I think too, maybe this is a little bit of a shift in strategy from a de novo site to something that has the assets they need, and we'll get more into that.
Yeah, so with the strategic implications here, how does Gevo's acquisition of Red Trail Energy assets in North Dakota align with some of the broader industry trends in renewable energy you're seeing, specifically, ethanol and biofuels?
Yeah, to me, Chris, on that one?
Yes, Brad. Yeah.
Yeah, look, one thing we should understand is that Gevo is invested in the alcohol to jet pathway. They're going to take molecules of ethanol, they're going to stitch them together, and they're going to make kerosene, right? This is sort of a future vision that they call power to electric in this world of 20, 40, 50 beyond. Today, we call it alcohol to jet. It's done with a chemistry process, just like a refiner. But to do that process, to be clear, to qualify for the credits that you want to monetize that jet fuel, and there's a significant subsidy stack on that jet fuel, federal, state programs that come on top of that. to monetize that, you have to have a certain carbon intensity, right? A certain amount of megajoules per unit of fuel produced. And in the case of alcohol to jet, because you're taking 2 gallons of ethanol to make 1 gallon of kerosene, you need a well. You need a class 6 well typically. That is going to be your ability to access that. Why? Because on the over the road 45Z, it's 50 cents to $1. When you're in the sustainable aviation fuel piece of this, it's $1.25 to $1.75. So your ability to access those 45Zs, it becomes much more valuable. You also are able to access 45Qs, which are the payments for the injection. You can go to California and access sustainable aviation fuel premiums there as well. And those can be in the multiple dollars. And then you're also generating RINs that are the traditional blenders RINs that we make off of biofuels, renewable fuels. So that the alignment here is that with the well, you can make the investment to scale the facility to then go into jet fuel production. And I think, as Dan's pointed out multiple times, you're in a great position to then send that out to the West Coast. And to be clear, California, Oregon, and Washington are the markets that are the most durable and paying the best premiums for you to stack on that gallon of jet fuel. So that's the mentality in this approach in terms of being able to access the sustainable aviation fuel market instead of the over-the-road market, and to access that additional subsidy stack. I'll say one last thing here. This is a view into the future. Maybe a week later, and kind of under the radar, Red Trail put out a press release that they just received a patent on making olefins. And so if you can put ethanol together and you can make jet fuel, you can put ethanol together and you can make resins like plastics, you can make other value-added resins. And people always say, well, what are they going to do with that? Don't think about it in your food packaging. Think about it in your sneakers. Think about it in your fashion apparel. Think about it in your watch band or your iWatch band, right? That's the places, these super high margin markets, they're going to come in there and be able to tell this really impressive story about how this is the super sustainable plastic resin of the future. So today, access to the alcohol to jet, access to jet fuel markets, the future, access to value-added petrochemical markets.
Hey, Brad, I feel really old right now. Do you know that? And the reason is that I looked at corn resin going into plastics like 10 years ago. I hadn't put some money into it, about 10 years ago, because it was all about biodegradability of plastic in the dumps. And corn resin based plastics it's funny that you bring that up, because it's like, I get it. And it's what instead of petroleum, we now use that resin that goes in there, and then it's biodegradable. So, there's another plus for the ethanol spot in the world. But Chris, back to your comment, and Brad, just a little bit off of that. This isn't just about Gevo. This is about the industry and where the industry is really going, and what's it going to look like, 4 to 5 years from now, and is it going to, because, if we take a look at, where you can permit wells right now, which you need the well, got to have the well. Pipeline, questionable, but well, 100%. And to get that, you can, for speed, as time is so valuable. Heck, I'm so old, I don't even buy green bananas anymore. But it's that's pretty funny, isn't it?
Good one. I like
you
that.
Like that? But as I think about it, it's the industry is going to be different. So you got North Dakota, Wyoming, and Louisiana, who will who have state approval. They don't need federal approval. And right now, I think it takes, what, Brad, probably 5 years to get federal approval in any other state out there other than those three. And it's tough. And so what's going to happen? And as we look at this, the demand for sustainable aviation fuel is big, but the demand for those other products that can be built out of that biorefinery are huge. And so the more we can lower those down, and I think it from a carbon scoring perspective, is really, really important. And speed is going to be important. I could probably even throw in here then. So right after kind of all these announcements, we had Harvestone announce a deal with Bank of America for $205 million. On credits, well, that's speed. That's giving them liquid capital to do what they need to do. So I think you're going to see a lot more of that in the industry. So I deviate a little bit from the original question, Chris. I apologize for that, but
No, so
I'm worried about my green bananas.
so Dan, I mean, you're seeing this then as also as the implications here. It seems to be a trend towards consolidation and economies of scale around this industry. Would you say that's accurate?
Well, I think, I think so because you look at the industry, it's very segmented or very disjointed. Let's put it that way. You got what, Brad, I think Poet's got what, about 14, 15% of the market, and they're the largest group that's there, and so if you take a look at that, otherwise it's a bunch of smaller plants. And those plants were built and put into where the corn growing areas were. Today, the world has changed, and it's really important. And I think that it's the demand for that sustainable fuel, aviation fuel, olefins, all those kinds of things. Brad, I agree with you 100%. And Chris, it just, the world is changing. So I think that you're going to see new capital come into the market, different capital. Let's call it different, new and different capital, different motivations, and people who, I think about the early days of the ethanol industry, and I go back to the gunslinger, guys who are out there and, it's like, giddy up, let's go. And today it's, you take a look at what, I don't think Bank of America walked into the Harvestone offices with a hat with a Stetson on and boots and, 6 guns. I think they had a briefcase and a suit. And I think that that's how the industry is evolving and changing quite dramatically. So.
I would just add there. There's a bit of a thought. One way I kind of frame it in my mind is, in the past, in the gunslinger age, right? We had to get the facilities built. We had to they have to exist, right? So if you're trying to create a renewable fuel world, especially in the past around energy independence, you got to get them built. And now we're in the era where they're going, all right, we're going to put you on this carbon intensity treadmill, and we're going to exercise you. Right? You gotta work now. You want that subsidy, you got to do a little better and a little better and a little better and a little better, right? And the folks that are able to deploy capital now are going to be in that position to have that long-term competitive advantage, right? Whether that's in the form of in that lower CI, that's not just about the subsidies that are going to come across your desk. It's about access to markets, international markets, right? Where international markets, big downer here, folks, but they make their own rules. We don't make the rules for international markets. So when you send ethanol to Taiwan, you meet the Taiwanese standard for ethanol. So I think there's this idea that this carbon intensity, I like to call it a treadmill, but this idea that you got to start to exercise, and the benefits aren't necessarily just the subsidy stack, but that ability to have that long-term access to markets or new opportunities, whether that's jet fuel or plastics and resins.
Yeah. So Brad, we said at JAG Group, one of our goals is to turn sustainability from a cost center to a profit center, right?
Mm-hmm.
So you kind of just started hitting on it, but maybe go a little further. Is Brad, what role do carbon intensity reductions play in their business models? And you kind of started touching on it right now. And so how does the acquisition by Gevo further their sustainable goal strategy?
Well, one is, it just be clear, market access. If they want to sell jet fuel, they're going to need a well, and there's only so many places in the U.S. they could go to, right? So if that's their end game, that's how the investors, they've been capitalized to do that, right? And so from that perspective, they got to have the well. That's just what makes the business model work. In terms of a long-term carbon intensity strategy, we've got to remember that we've kind of repositioned biofuels as renewable fuels, right? And what used to be about energy independence is now about sustainability. Who cares? I think if you kind of get wrapped around the axle on what the point is, you're kind of missing the point. The idea here is that now that we've said, okay, well, sustainability matters. And so if you're able to reduce the carbon intensity of your products, you're going to get more reward from the marketplace, the federal markets, the state markets, the international markets. And you're going to have more market access, right? You're going to be able to get into these markets, these global markets. Interesting piece on the global markets. I think scale is a huge piece of that, right? Your ability to produce large enough runs and export large enough quantities that your customer on the other side can buy an entire ship full of Red Trail ethanol or Gevo ethanol, right? They want to buy that thing where they know it came from that singular site. So I think as a long-term strategy, competitive strategy, getting your carbon down matters. That's why even outside of biofuels, and I love to talk about dairies, California has done a lot of work to subsidize digesters and other forms of lowering emissions at dairies in California. So if you're Nestle or you're Danone or you're some big international buyer of milk, you're going to come to California because they're going to have the lowest scores on their dairies because the government has put them in a position to win. And as a resident of Colorado here on the Front Range, we make an awful lot of pizza cheese. If you're familiar with Leprino, you know, what are we doing to make sure that we remain competitive and making sure that Domino's and Papa John's and all those folks keep lining up to buy our dairy products and they don't shift production somewhere else? So again, you know, we can look at it in the terms of ethanol, but you can also see the same, you know, mirrored across other industries.
Dan.
Hey, Chris, just hang on 1 second. Brad, I'm going to come back to you for just a second to prove your point. You know, you talk about market access and international market access. Interestingly enough, a lot of plants about 5-6 years ago, maybe longer, you know, you throw COVID in there and my time schedule's all messed up.
Yes.
But, you know, but it is, there were a number, and you don't normally send denatured alcohol abroad. You send pure alcohol abroad, which is you have to put those in separate tanks. You have to have security systems because now you got ATF involved with it. And it's, which is there's a lot of regulation. But why did those plants do that 5 years ago? And again, this is the maturation of the industry. They were looking for international market access to give them flexibility. And there were a number of plants that did that. You know, I can go 20 miles west here to out in Castleton at Tharaldson Tharaldson Ethanol, and they've got a complete, you know, a separate facility because you got to store it in different tanks. You got to do all these things different with it because you can't have intermingling and the amount of record keeping and all of those kinds of things that have to happen. And it's incredible. But there were other plants. So the industry is always looking for new opportunities, and the markets will always vary, you know, and it's so you got to look at all of those different things, and it's really important. So
Dan, with that, why was Red Trail's installation of the Class 6 well such a game changer, specifically in regards to some of the ongoing issues we've seen with pipelines and pipeline access?
Well, you know, talking to some of the board members, they were very insightful. They knew because you could take a look. And Brad, I know we had in our JAG group, we have some really cool maps that show where wells are, where plants are, where pipelines are, where blending facilities are, where ground structure can determine where all of these facilities make the most sense. Railroads, waterways, all those kinds of things. We can go through those criteria, but we knew that the board knew. Let's put it that way. That and Brad mentioned it earlier about the Pacific Northwest and then California, Washington, Oregon, and British Columbia. So in Western North Dakota, you have the shortest logistics. There, you have a trained labor force that understands the petroleum industry because of the Bakken and all of the things that were going on out there and the ups and downs. And so there was an opportunity. And we understood the deep geographic developments that are underneath of the earth here, and where did the oil come from? The oil and the natural gas in North Dakota came out of these pockets of underneath the shale or shale developments or in the shale, and that were captured. Think of it like a balloon. Is really what it was. It was like there's all of that oil and stuff and gas were under pressure underneath there, trapped in that earth, and it was pressure. Then it was really interesting. Then I'm going to deviate for just a second, but you know, when they put numbers of wells in, it was like, you know how you put a hole in a balloon and you get this little that comes out of it. Well, as the more wells they put into the balloon underneath there, the pressure would drop, and so wouldn't push us out as much, and that's when fracking kind of came about and all that kind of stuff. But what I wanted to say was that those formations have been there forever. So we knew the geologic formations that were down there. We knew that we had the hardened infrastructure to go to the west. We had all of the kinds of things. There was an intermediate stuff in Billings to a blending facility there that if the market wasn't right, you could stop it. You could deliver your product there. We knew that the things that Brad talked about, and one of the things that we visited about a lot, was the development of that bio refinery based industrial complex that you could potentially put there, because you just go back to I think in our first podcast we talked about the basics that are there. You have electricity, you have water, you have roads, you have corn, you have labor, all those kinds of things. And so the well went in, made perfect sense. North Dakota has dealt with the energy industry, and that's why they had the ability to permit their own wells in the state, and they've respected that and honored it very well from a political perspective. And so when you looked at, and the other group that I was with Midwest Ag Energy, that had the Spiritwood and Underwood plants, the Underwood plant has a facility, a carbon injection facility there. Those decisions were made because we could, and we knew that. So the Underwood facility had a rail line that goes up into Canada, into British Columbia, and Red Trail had the rail line that goes west out to the Pacific Northwest. Short logistics. So from a business perspective, it made sense.
Yep.
Was it risky? Big time. I mean, there was believing and having faith that the market was going to go where it was going to go. So, and that we knew that sustainable aviation fuel and carbon scoring and ESG scoring, all those things come into this new world, 5 to 8 years ago. And that's when we started to see those things started to happen. And they had to make the decision. And the decision was the right one, because both of those plants, both of those facilities or groups have now been sold. And it's about, when you take a look at an investment portfolio, you're going to look at it and say, I got to have an operating plan, because it's nice to have that cash flow spinning. And then potentially, and I think, and I don't know this, but, I would say that you raise capital through a tax equity tool to give you the liquidity you need for the future to do other things. So,
now, Brad, I have ADD in a public education. And so could you kind of show us a visual, or bring up and share screen, and kind of what Dan kind of talked about, and show some of the interplay of those requirements and criteria that we would kind of need to get that optimized model?
Yeah, more than happy to. Let me share here with you. Take a look at.
And for when you have this up, for those that'll be listening versus watching, if you could make sure to kind of also, closed caption highlight, what it is they're looking at.
Absolutely. So we're looking at the state of North Dakota, and across North Dakota, we see a couple points, which represent the different ethanol sites. And Red Trail Energy being here, I'm clicking on that out to the west, talks about what its production capacity is. One of the things I want to show folks is just simply the CCS potential survey. So
now, this is a tool you developed, right?
This is a tool we've developed to help people understand how the location, how the geography, how the infrastructure they have access to is going to dictate their long-term competitiveness, right? And if we zoom out here, I'm zooming out, you can see that the primary CCS surveys, right? These aren't we get into the weeds on saline basins, basalt, et cetera, but this is one of the primary CCS surveys. North Dakota is a big winner. Louisiana, Texas, the Gulf Coast is a big winner. Large portions of Wyoming, big portions of Nevada. We see those as places that are open to injection, right?
And the trend I'm seeing here is that most of these facilities are not in a location where they could put in a well.
That's right. We bring up saline, you'll see that you get additional storage across Nebraska, the Ogallala Aquifer, places that you might be able to inject. Illinois, so this is the basin that would be under Marquis's Hennepin facility. So we do see different types of basins that are available. The other piece we'd point out here, just as we're looking at this really quickly, is that we go back to the new Gevo, formerly Red Trail, and we take a look at things like railroads. We can see they're on one of the main lines here. All of these folks are going to be on main lines. We can take a look at where the natural gas pipelines are here, which comes right by all of these. So we've got a sense we've got different locations for different folks that would be able to deliver here, where the Camelina is in the world. We've put a lot of different things on the map to help us understand how we make choices and how those choices connect to, can I put this ethanol on a barge, right? Can I lower the carbon intensity of it through the locations that I have? So,
Hey, Brad, can
yeah.
you pull that out and just take a look at waterways? And if you take a look at Louisiana as being one of those states, and what does that mean as you come from a waterway perspective, and where we could see, corn probably going to a location where a plant may be established or a well is established?
Yeah, absolutely. If you look at what we should never underestimate the value of waterways and lowering your carbon intensity. It's very important. Actually, low water levels, when we start to put restrictions on weight, that actually increases your carbon intensity, right? Just the water level in the river is going to have an effect on that. I mean, if you go down and look at Louisiana, we've got lots of injection potential. If you look at the number of well applications in Louisiana, it is some wild number because of oil and gas. It's down there already. The last point we should make is Louisiana is one of the states that does not have to go through the federal government to get this permitting done. So they're going to have a lot of injection going on in that state. So you might look at Louisiana, which has traditionally not been a siting choice for ethanol, and start to let the wheels turn in your brain and think, okay, well, I can get the corn down the river, and I'm down there with all the oil and gas folks. So I have all the equipment and expertise and everything I need. And I'm sitting on top of a big carbon capture and storage basin. It starts to look like there's untapped potential in Louisiana if you can get the corn there. Right.
Yeah, that kind of leads me to my next question for you, Dan. With Red Trail located in North Dakota, how will this acquisition affect local farmers in the grain supply chain, particularly for corn, which is the crucial for ethanol production? And if you could tie that into kind of what Brad alluded to about, it may not always necessarily be that you have to have a plant close to the feedstock.
Well, I think right now, if farmers, this is really interesting. It isn't just about your carbon score. It's about how do you transfer the data into a facility, because you still have to get through the verification process. The plant, there's only one relationship for the federal government or the IRS, plant to IRS or Treasury. Okay, that's it. None of the other things here, there's a relationship. So the plant generates the credit that Treasury issues back to that plant. So you have to go through a verification process. You have to go through a lot, which is all the plant's responsibility. It's not the farmer's responsibility. It's the plant's. The farmer has information that goes into that verification process. We learned that years ago and as we worked on voluntary carbon credits in a previous organization. And it was, which is a very difficult thing to do, very, very difficult. And because you have all these different pieces of information, farmers today in North Dakota, and I'm going to break this apart. North Dakota, if you're not doing everything you can do to find ways to bring data in and then be able to move it on to the next site or the next it's almost no different than moving grain. We bring grain in trucks, and it's all about transportation economics. So you move the grain from the farm field into an elevator, traditionally to an elevator into a barge, or into a bigger truck or a railroad car to move to a barge someplace to send it down to be exported around the world. Processing today has changed that a little bit, but not a lot. It's all about transportation. Same thing basically is going to happen with data, and you have to think about it that way. It's from one place to the next, okay? And it may be different in different areas. Now, with what we just talked about, and with North Dakota, Wyoming, and Louisiana being the 3 states that could really move quickly on carbon injection, you know, does North Dakota make enough grow enough corn to do that? No. Does Wyoming? No. Does Louisiana? No. So, but the I states do. Okay. So we're going to have to figure out, and when we're well on the way with that, with some of the relationship we have at JAG, and is that it's like, okay, how do we move this data? How do we take and bring it into from a place in Tumbleweed, Iowa, that you're going to move into a new processing facility in North Dakota or Wyoming? Okay. Wherever that next logistics, it's about economics and all this stuff. So farmers today are going to have to take a look and to work with, those plants that want and desire their product from a fuel perspective. But now farmers like myself, you're going to want optionality, and you're going to want that flexibility and market access. So it isn't just about biofuels. It's going to be about feed, and it's going to be about food. I could talk about fiber, but I'm not going to right now. But it's going to be about feed, fuel, and food. So, Brad mentioned earlier Danone and those dairies that are out there, and they're going to be looking for that lowest carbon food, dairy product as they possibly can get, and bring it into their facilities because they want those things to happen. Okay, and they need those things to happen. So from my perspective, farmers today have to be looking at everything that they're doing, and from even an investment perspective. And if you want more money for the bushels you have, I was just looking on my screen. My screen went dark over here on cash corn. If I were to ship cash corn today to Tharaldson Ethanol, I'd get paid $3.53 a bushel.
Oof.
Wow.
50
was the
years
last time
ago.
it was that price, Dan? The 70s?
It's been a long. No. It's been a long. No, the 70s were actually higher. I can take a look at, that in the 70s we were probably, at times, $3.90, $4. It was up there to come up. You'd have those times that come up and go down and all. We've been through markets. I mean, that's every year it seems like. But right now we're a disproportionately different number. How do I fix that? Do I just, as a farmer, do I just take it? Some do. But if you want to be in this game for the long term, you have to change that. You have to be able to find your optionality and your market access, no different than what we're seeing happening in the ethanol industry today. Farmers have to do the things they need to do to enhance and enrich the bushels they have with data, because that'll be the next commodity. It's going to be data that's off of those fields that you've done the things to. And Brad, I know we've been looking at, today, I'd probably say, to qualify, we're going to have to use nitrogen efficiency for, highly efficient fertilizers. And we're going to have to be very, very diligent about how we apply and use our nitrogen, because they're probably going to say we're going to have to cut it back a little.
Dan, quick.
That's going to be a tough deal. But, in that situation, there are ways to do it. And so I think that you're going to have data, and you're going to have to find ways to get the same yield or better yield with less nitrogen is the bottom line.
And Dan, quick calculation: $3.90 in 1970 is $31.64 today, adjusted for inflation. That is crazy.
I remember buying a four-wheel drive tractor in the 70s, and it was
so
about $70,000.
Let me show. I want to show one fact here, because this is somehow the tooling we're working on as well. Is here's the nitrogen rate, and you say, well, what's this from? This is from Argonne National Labs in 2019. So when they go to put together the 45Z credit calculations, this is the data set they're using, right? And they're showing you high usage rates compared with low usage rates, right? But the thing to look at here is when we go and let's look at non-irrigated croplands. This is CPS 590. This is the standard for nitrogen reduction that the NRCS uses. And we can look across the country and start to see regions in which that reduction is going to produce the most benefit. If we look at irrigated croplands, we can see it that way as well. We can also go down and look at what happens if we take, say, conventional to no-till in these systems as well. So the impact of these farming practices is going to vary across the landscape. Just another thing as we think about the impact on the farmer and where the corn's coming from, more tooling. That this is sort of our perspective of the world of what do these interventions mean at that county level, right? How are they being calculated, and how do we start to think about the regions that are going to benefit from some of these regulations, and the regions that are going to have to Dan's point, really get focused on use of enhanced efficiency fertilizers, nitrogen management, other practices they might be seeking to qualify these climate smart agriculture feedstocks
So
in corn and beans.
follow-on question, Brad, then given that biofuels production and CCS technology are highly influenced by government incentives and regulations, how might IRA policies like 45Z, 45Q, and LCFS impact Gevo's strategy post-acquisition?
Yeah. So one thing on the 45Q is that it's sort of the way it's written right now is the direct pay on that is a 5-year program, as I understand it. So that means you get 5 years of payout over that well. And if you just keep the well as it is today at that Red Trail facility, the lifetime value is about 76.5 million in 45Q direct pays. That pays for the well that was 35 million, sort of free money on top of that. But at the end of that, where does it go? And what has been done by Red Trail was they got approval through Oregon of that injection pathway. So when the direct pay for those credits ends, they'll be able to turn around. There's a couple options they have, but one option is they've already made sure that a usage market in Oregon is accepting that reduction of carbon because of the well. California, we'll see. They're as slow as the federal government in getting this stuff done. So in that sense, but we would expect eventually they come around and acknowledge CCS is occurring at that site. Canada is going to be able to do some similar things. It's a great opportunity. So from that perspective, you've got that. From the 45Z perspective, you'll continue. That's a 3-year program. There's a 7-year extension right now in the House and the legislature, the federal legislature, trying to get that moved forward and continue that.
And for those unfamiliar, could you just give a quick highlight of what 45Z is?
Yeah, it's the treadmill. That's the carbon treadmill. So it says, okay, you got to. It's a simple. They go, okay, here's the value for megajoules, the amount of carbon it takes to make this many megajoules of fuel, right? How much energy? It's based on energy, like calories. And so you have to get to half of the number of the fuel, right? Of unleaded fuel. If you're in ethanol, we're going to focus on ethanol. Half of that number, and you start to earn, and that's the over the road at 50 cents a gallon. So you get paid 50 cents a gallon, 45Z as a tax credit. Those credits have to then either be applied against your tax liability, or because of the one transfer rule, which makes them different than the former solar credits, they can go to another party, right? And that is the basis. We'll kind of jump into that, but that's how they're doing the treadmill, right? So and then if you get another a little lower, you get another penny and another penny and another penny, all the way up to $1, right? And that would be a facility that is making zero. The carbon is zero in that fuel, and you get $1 a gallon to do that. So if you're 65 million gallon facility, that's $65 million a year in tax credits that you can sell to other folks or use yourself. The tax equity piece of this that I think is a little is maybe underappreciated by many, but certainly not by Harveststone, is that if I put a well in the ground and I know that for 5 years it will pay me $85 a ton to put carbon into it, and I know how much carbon's going into it, I can go to a bank, I can go to a lender and make a tax equity deal. A tax equity deal says, give me cash today and I will pay you back in tax credits over the life of this project, right? That allows you to access capital today to do the project up front and then pay back over time. So that's why the Qs are a 5-year program. When we look at the 45Zs, they're a 3-year program. A lot of that tax equity looks like combined heat and power, and it looks like parts of those projects. But it looks like those sort of engineering efficiencies. But tax equity is a way that we can access capital today to invest in those tax credits that'll get issued into the future. So that's a really important piece of how these sustainability structures work, is the ability to do tax equity deals on top of them.
Isn't there a motion right now to extend those 45Z tax credits out another 7 years?
That's right. That would give you 10 years total on that program. And to be quite honest, the idea that they're going to pull the production tax credit, the 45Z production tax credit out from under these facilities, that would be pretty tough. And why? Because RINs are in the doghouse right now, right? RINs are down at 50, 60 cents a gallon, where they should be more $1.50 to $2.50. So it's tough. The other pieces of the stool that you need to hold up the production here just are weak right now. And the idea that two markets here, that there's some sort of inside baseball stuff, is LCFS, which is the California Low Carbon Fuel Standard, and the excuse me, my train of thought there, the 45Z, and these markets, we're exporting it. What we've done with the bean oil and the production of renewable diesel and sustainable aviation fuel is, now if you're Phillips 66 and you're operating a facility there, in the past, California in the low carbon fuel standard, it's a cap and trade market. So you have to buy allowances to emit, and you earn allowances by producing sustainable fuels. Well, if you're Phillips 66 and you're producing huge amounts of sustainable aviation fuel and renewable diesel, you're now generating your own LCFS credits and the cap and trade system. So the demand side has become weak because of increased production. The same can be seen in the RINs markets, where we have lots of RINs production, and the demand for those RINs is weak right now. And so we just have to be mindful that as we brought oil and gas into the renewable fuels family, and they're sort of rowing directionally in the same direction with us, that they are going to produce imbalances in the supply and demand of these credit systems, where you have allowances in them.
So final question for today's video and podcast, directed at you, Dan. What does this acquisition signal about the future direction of the biofuels industry, and how might it influence competition between traditional biofuels producers and other consumers of feedstock like CPGs? And then finally, like, if you could just sum up, why Red Trail and why North Dakota?
Well, I think we've talked about that, and it's logistics and the probably the openness of North Dakota's political environment for the regulatory side of it, and their ability to have had great foresight into working with the oil and gas industry here in North Dakota to be able to have your own permitting process that works today. That to me is why North Dakota had a great political environment, agriculturally focused. And so for growers here today, it's a big deal. For companies who are trying to build those biocomplexes of, the industrial complex around plants, it's a great political environment, great tax environment. It is, we embrace it.
Great workforce.
Great workforce, trained workforce. So those are really important things that understand the oil and gas industry, and then you have the amount of creativity that came out of even the ability to connect information from data and everything else. Is North Dakota's always been in creative. The 4-wheel drive tractor, the skid steer loader, all those things came from here, and was not to sit here and say, aren't we the greatest? We just have really short windows to plant and really short windows to harvest. So you have, because of the weather that we can get here, you've got to be creative. You've got to be able to think out of the box, and that's what North Dakota's always done. And that's you got to take your hats off to Red Trail and to Midwest Ag Energy and its foresight and the leadership of those companies, because they knew. And North Dakota is also a place where people are willing to take a risk, and because we have great backing behind the state government and everything else that's here, it's a big deal. But I can say the same about Louisiana probably, and the same about Wyoming, that they have those kinds of things as well. But where do I see it going? I see it that those states are going to become the hotbed of activity, and I think that time is important, and that in any kind of business, if you don't have those situations where you have access to those markets, as the pipeline's trying to do, it's going to be difficult. It's going to be difficult, not impossible. Back to that creativity and ingenuity, there are probably other ways to sequester carbon in the earth if we have to. And we'll find it. And there are today, we know that, but the cost of it sometimes are prohibitive. And sometimes the rules and regulations of, I'll give you an example, just taking corn stover off a field should calculate and help. If we can take some corn stover off field, should calculate to help the amount of the carbon that's not going to be emitted into the atmosphere somehow. And I think those are things that are important that we've got to look at from a rule and regulation perspective and where it's going. I think we're going to see differences in the industry. We're going to see new players come into the market, and I think that's healthy and it's good. So, and hopefully the government will let us continue to move on and be able to take care of our national security, our food security, and our fuel security. I'm just sitting here. I've got CNBC on another iPad right over here, and I'm looking at fears of oil supply disruption is the headline that's coming across the scroll right now, and it's like there's uneasiness in the Mideast, and it is affecting. I think we got a $3.31 drop in oil prices today because they backed off those highs. They were going up really high when all of the turmoil. We can create our own destiny and keep our economy and our nation strong if we embrace above ground energy and what we can do with it. So
Dan, you have a lot of experience working with CPGs in the past. How are they looking at this?
Yeah,
what are their thoughts about it? Are they afraid of the competition, or is this going to be some impetus for change and possibly drive up prices, for the farmers because there's going to be competition for this feedstock?
You know what? I think that they're gonna have to take a look at a number of different things, and creativity is going to be part of it. Let me, I'm gonna go off biofuels for a second, but it's related because the wet cake coming into feed is going to be important. So why does Walmart decide to put its own harvest facilities up, if you want to call it that, in the beef industry? And the reason is that maybe they're not getting the reaction time fast enough and speed fast enough from some of their suppliers like JBS or Tyson. It's not happening fast enough for them, and they know that they've got to be there. So they're creating their own world, their own world of how they're going to deal with it. They're buying calves in Western North Dakota and feeding them, and they're coming off of rangeland that has a 0 carbon score or less. They're putting in corn that has data attached to it, so they can verify and do the different things. And there's demand for that. If I go down into Nebraska, Western Nebraska, at a little ethanol plant down there, they don't have a drying facility. They only have is they take wet cake and they send it out right into feedlots every day, and they have a demand for it. I think we're going to see more and more of that, and I think that as we look at that, I think we're going to see the CPGs having to move more quickly and building stronger relationships with growers. And I think that as a grower is a good thing, because then we can take a look at it doesn't always have to go to the ethanol plant. It could go to the food groups if we need it to, and so that should be good for for somebody who was an economics major, should be a pretty positive thing. So.
And that's, Chris, there's like a whole podcast. And what are the knock-on effects of this biofuels patterning of the space, right? And this idea that if you start handing out scores that are backed with the full faith and credit of federal tax incentives, then why wouldn't I claim my corn when I drive over to the food facility to drop off corn? Why shouldn't I claim a carbon intensity? Last year I claimed it, or even the same year I claimed it over there. If I'm buying wet cake off of a facility, why shouldn't I claim that CI? Especially if they have a well or they're hooked up pipeline or they're doing something with combined heat and power. I should be able to take advantage of that because the world's changed now. So the knock-on effects of this, I think we haven't even really started to wrap our mind around.
Brad, I think you just gave us the topic for our next podcast.
Happy to discuss. It's the food side of this is I've got lots of thoughts there. We should do another podcast on that. Just the lack of intervention in food right now. It's
I love
just.
Well, Brad, Dan, thanks for joining us on the Data and Rich Bushels podcast, and I look forward to having you guys in the next episode.
Great. Thank you.
Always
Guys.
good to talk,
Thanks,
gentlemen.
See you, gentlemen.
Thank you. Bye.
We'll see you.